and welcome to this episode of IPO KYC. I am Reema Tendulkar, and with me today is Yash Jain. The company that we are focusing on is an EV charger manufacturing company called Hexacom Telesystems. It's a 429 crore IPO. The bids for the IPO will open on the 27th of February. Now, this 429 crore of the IPO size comprises of a fresh issue of 329 crore, and plus there is an offer for sale of 100 crore rupees where the promoters will be bringing their stake down. The company's total market capitalization will stand at close to about 1,700 crore rupees. The company has set a price band of 135 to 142 rupees per share. To talk more about this company, the way forward, the details about this company, let me welcome Anand Nahata, MD and CEO of Hexacom Telesystems. Anand, thank you very much for joining in. I know we introduced the company as an EV charging company, but this is a company which derives 70% of its revenue from critical power business, where you provide uninterrupted, reliable power backup to telecom companies, and the balance 30% comes in from the EV charging business. Right. So let's talk about the power business, right? 70% of your revenues. What exactly do you do, and is it only telecom that you cater to here?
First of all, thank you, Reema and Yash, for having me here.
Thank you for coming to Mumbai.
It's my pleasure. So, as you said, Hexacom is about a 30-year-old company, and we operate in two business divisions, critical power and EV charging. Critical power, we manufacture certain specialized power electronics, namely what we call as DC power systems and lithium-ion batteries. What they do is keep the telecom network up 24/7. Telecom network has specialized power requirement, where they work on DC power. So our equipment kind of take the raw grid power, which is AC power, convert it into DC power, and our batteries provide backup when there is a grid failure. So together, basically, the job is to keep these important communication networks light on 24/7.
Anand, of course, you spoke about how the power division functions. Of course, the RHP shows that about 50%, slightly over 50% of your power revenue comes from the top 5 telecom clients. You said, of course, that's one sector which requires 24/7 support. What is your strategy in terms of diversification beyond these top 5 clients and reducing the concentration? And which other sectors have you identified which may require similar requirements in terms of 24/7 live support?
Absolutely. So this critical power business is a B2B business. So by nature, the consolidation in terms of the top customers will be there. And we service telecom industry, which is dominated by large IPP players, whether the tower companies and the telcos. And our customers are these, whether in India or the other geographies we operate in, which is Southeast Asia, as well as Africa. So the nature of the business is B2B sales. But in the ongoing energy transition, there are more opportunities which are coming up for the product categories that we are in, whether it's the data center, which are now seeing transition to adopt lithium-ion batteries from traditional lead-acid batteries, or it's the microgrids which are coming up for applications like rural electrification, or some of our building blocks from critical power solutions are also going into applications such as battery charging for the swapping batteries, for example. So I'm hopeful of some more of these applications come up in future to diversify from the core telecom business that we are in.
So just in a nutshell, your critical power business has DC power systems and lithium-ion energy solutions, and you largely cater to telecom as of now, right?
Correct.
Most of your revenues comes in from the telecom infrastructure. Now, particularly about this lithium-ion energy solutions, right? They require batteries. Do you import those batteries? You were earlier looking at manufacturing it. Have you started manufacturing? What's happening over there?
So we manufacture what we call as the battery packs, and what is imported in India right now, whether it's us or anybody making battery packs, is the lithium-ion cells, which is a major constituent of the battery pack.
Okay.
Today, there is no manufacturing of lithium-ion cells in India. However, thankfully, government has put in place a very strong program to boost cell manufacturing in India under a new PLI schemes, where several companies have bid. And as per various media reports, several of these gigafactories are under construction today. So between 1 to 3 years time frame, as these factories come live, I'm sure a lot of this procurement, whether it's by us or the industries in general, is going to shift towards domestic procurement of
So you
these cells.
import lithium-ion cells to manufacture lithium-ion battery packs,
Exactly.
which go to provide power backup or energy solutions for telecom companies and data centers.
Absolutely, yes. And when we procure cells, we combine it with other materials, which is a BMS, battery management system produced by us, and other components which go in a battery pack. So we
your
convert cells
competitors
into
in
battery.
this would be?
So there is, in batteries, there is a big space, whether it's the traditional battery companies like Exide,
Amara Raja.
or some of the new age companies. Conversion to lithium ion is a global trend, and EV has made it more popular and more affordable for many sectors, including telecom and other stationary applications. So host of players are attempting at it.
Anant, let's speak a little about the fancy business, the electric vehicles business. You were an early entrant as far as the business is concerned, about 60% market share as far as the residential side is concerned, 25% on the commercial side. Break down your role as far as this space is concerned. There are various, departments to this particular business: procurement, assembly, maintenance. Where do you come into play, and what is your role as far as the sector is concerned?
Correct. Right, Yash, we started this business in 2019, and thankfully, due to industry growth and our relentless effort, today we have 60% market share in residential charging and 25% in commercial charging. Our role is as a technology player and a manufacturer of EV charger solution. We develop technology and then manufacture EV chargers for variety of applications. It may be home charging. So if you as a consumer, you buy a car, usually you will get a charger along with the car, which you will put at home and charge your car overnight. Or it's the chargers in the public charging space or bus charging space, where you would see these chargers being put up by various infra players as part of the city infrastructure or as part of bus depots for charging those vehicles as well. So we manufacture these products for all such vertical markets.
There are multiple stakeholders in the EV charging business. We have the Tata Power HPCL tie-up, GeoBP. So where do you come in the ecosystem?
So we are providers of products to such companies. The examples you took, whether it's Tata Power or GeoBP, these are infrastructure players, or what we call in our industry, network operators of EV chargers, who are creating nationwide network of such EV chargers, so people can go to these charging points to charge their cars. Like today, we go to fuel pumps to put in petrol in our cars.
Okay. And there is a battery involved, right? Sorry, in the EV charging system. Do you manufacture the battery or are not involved in it?
Batteries are part of the vehicle. So as EV charger manufacturers, our job is to charge those batteries. So your car can have the range to travel the kilometers you need to travel.
Anant, of course, the business is at the moment at a very nascent stage. We're seeing the adoption of it. You've alluded to a report in your RHP talking about, how CRISIL sees the market, the EV market, to grow at 50 to 60% between 23 to 28. If 50 to 60% is the EV market growth that one is estimating for the charging solutions industry, what is the growth that you estimate? And as you sort of go down this journey, there would be more players which would get added. Market share will get distributed. In the next 2 to 3, 4 years, what is the market share that you sort of aspire to have as an early entrant in this space?
Right. So as you rightly pointed out, Yash, as per CRISIL report, the EV charger market is expected to grow between 50 to 60% CAGR over the next 4 years. Or in terms of numbers, that means 1,200 crore market will go to almost 9,000 plus crore market in the next 4 years. We were one of the early entrants in the business, and while we have had really good growth, but let's appreciate that these are still early years in the industry. As a country today, we are selling about 100,000 passenger vehicles, electric passenger vehicles, about 2,500 buses, and there's a huge room to grow. 1 lakh cars is about 2.5% electric vehicle penetration. Imagine what the market looks like when this becomes 10% or 15%. And that is the market that got us excited for this business. So rather than the just market share, we are very excited about the absolute volume that this market is opening up. And as far as competition is concerned, today there are very few players in the industry, whether it's the auto OEMs, whether it's the charger manufacturers, who's educating the market. So more competition is absolutely welcome. If there are more players trying to grow the industry, that will have a positive flywheel effect, right? So more chargers on the ground increases consumers' confidence to buy more electric cars. More electric cars on the road, further demand for chargers come. And that is the positive flywheel effect industry should be looking at. As far as our market share is concerned, we are, if you look at RHP, we have certain strengths in the business, right? We have almost 30 years of domain experience in power electronic design and manufacturing. And that's a common theme between our critical power business and EV charger business. So that got us started with EV charger business much earlier and faster than some of our peers. We are investing the money being raised over here into new capacities, into R&D, into building new products, and hopefully that will pay us good results over time.
What about margins for the EV charging business? On a consolidated basis, your EBITDA margins are 7 to 9%. Considering that the EV charging business is still in the nascent stage, there are a lot of investments, the ecosystem is developing, the infrastructure is still gaining momentum. Are the margins lower or higher than the power business?
So, as you rightly pointed out, the consolidated margins are 9%, and EV chargers has seen a lot of growth, but still in early phases, a lot of growth yet to come for the industry. As far as specific margins are concerned, that is...
higher or lower?
Higher or lower.
So I would just say that today our consolidated margins are in the range that you...
But it's profitable for you.
We are still in the investment phase, and and our focus is to make sure we achieve our growth plans and the business plans that we have set out for ourselves.
What are these growth and business plans? Tell us about your targets.
So, as we spoke earlier, the industry growth targets for EV charger market are between 50 to 60%. And that's a huge growth from 1,000 crore plus market to 9,000 crore plus market. We are a leader in this market today, and we are investing this money to make sure we continue to be a leader in this market even in future.
Just one, of course, clarification. As far as the revenue breakup is concerned, we spoke about 70-30. This market, the EV side of the market, is growing very rapidly, as we just spoke about. Do you see this particular breakup between the two businesses reaching 50-50 by about 26 or 27? Is that a fair understanding? And if that happens, from the current point, could the margins trend higher with a 50% breakup, or could it trend lower?
So, specifically on the breakup of future, I cannot comment. But if you see our last 3 financial year data, in FY21, I think about 8% of our revenue came from EV charging. Then it rose to about 10%, and in FY23 it was 30%. Even in H1 FY24 is about 30%, and that has been due to higher growth rate of the EV charger industry, and also maybe there was a benefit of a small, a lower base as well. At core of our business, it's a common power electronic business. We are investing in an integrated manufacturing facility. We'll be ready for growth from both our businesses. We'll have to see how the split works out in the future.
Okay, since we're on the subject of financials, now FY23, your revenues came down. So FY22 revenues were 842 crore. It's dropped to 708 crore. And this is on account of the power business seeing a decline. What led to that decline? And is it often that we see, revenues for the power business go up and down? Is this that, volatile a business?
So fiscal 23 was quite an unusual year that globally we saw with the semiconductor shortage particularly. And that affected a lot of industries. At least in my career for 14 years, this was one of the first such events that I saw in the electronic space. And it impacted us also. So it was very important for us to choose revenue based on our capacity and what we could profitably deliver, or with some business sense, and not go after everything in this period of semiconductor shortage. And that was the main
reason for the decline.
Correct.
So
And
we have only a 3-year, historical, revenues, right? So tell us, over the last 14 years, since you've been in the business for 14 years, what's the 5-year, revenue growth rate, CAGR, or a 10-year revenue growth rate for the power business? Because this appears to be a steady state business.
Yeah. So telecom is a mature industry, and if you see the CRISIL report, the growth rate for the products line that we are in are forecasted at
historical. Your historical growth rate has been?
The historical growth rate also has been between 8 and 10%.
Okay.
And even as per for future, the growth rate forecasted by CRISIL for our products line is between 8% to 14%, depending which product line you look at.
Okay. I mean, since we spoke about one exceptional year as far as the year of semiconductor shortage is concerned, the first half of FY24 has also been exceptional on a year-on-year basis in the sense because you've nearly doubled your revenues in this period. Taking the point that Rima put to you forward, 100% growth in revenue in the first half, there's a contraction in revenue seen in the previous financial year. What is the number in terms of a sustainable revenue growth which investors should expect? If not a number, then a range that you see yourself growing, at least for the future course of years.
So the first year in FY24 has been good for us. So yeah, the semiconductor issue reversed, and I think at least generally I feel that is past us. But not just that, there has been continued investment in 5G capex in telecom sector. There has been large government programs to build telecom infrastructure to connect uncovered village or border village where we are beneficiary of certain component of that business, especially to do with power infrastructure. There has been continuous adoption of lithium-ion batteries by all telcos and tower companies. And on the EV charger side, the industry continues to grow. The number of vehicle sales in electric vehicles has almost doubled compared to last year, which obviously has a direct impact on the EV chargers. All these factors put together has led to the growth in FY24.
Correct.
As far as the future is concerned, the industry growth rate, which is estimated by CRISIL, is about 50% for EV chargers and about 8 to 10% for telecom.
Okay.
So
so about 30-35% on a.
I can't comment on our growth, but we have business plan and we are investing in future, with capacities, with investments in products and R&D to achieve our growth plans.
Just to follow up, we'll also see the migration from, of course, 4G to 5G networks in some part of current financial year and some part of next financial year. Does that sort of, have a negative impact on your revenues, or does that impact it positively, if you can explain that?
So anytime there is a technology migration, whether it's 4G to 5G or whether it was 3G to 4G, or in future if it will be 5G to 6G, this generally technology migration means more data consumption, higher speeds, and that technologically means more towers, towers at fewer distances. So that always has a positive impact on telecom infrastructure business, including ours.
Okay. Anand, I was looking at your gross margins and your EBITDA margins, and if that plate will just, come up. Your EBITDA margins have been inching up. FY21 was 5.75%, 22 was 8%, FY23 was a little lower at 7.4%, but maybe it's on account of, the revenue shrinkage that we've seen. But H1, FY24 has seen your margins improve to 9%. Will the margins continue to improve for you? And what are the, gross margins for the company, going ahead?
So the historical gross margins have been at about between 25 to 27% EBITDA margins you just mentioned. And as we go forward, and historically also we have worked very hard on bringing out newer products, making our operations very efficient. We are a common power electronic business, so the more we do of any business lowers our operation cost, and that is going to be the theme going forward as well.
Should we read that as a yes, that margins will continue to improve? Double digit?
So the intent of any company would be to continuously grow its revenue as well as margins, yes.
Okay, so since the objective is to grow, let's talk about the objects of your issue. 329 crore of a fresh issue and 100 crore of an offer for sale. Now this 329 crore, out of this 146 crore goes towards building a new assembly line in Telangana. And this would be your fourth manufacturing facility. You've got one in Solan, two in Gurugram, and now Telangana would be your fourth. What is the timeline of production and commercial sales? And at at full capacity utilization, what could be the peak revenue that you will generate from this new facility?
So we are investing about 170 crores in this new plant, out of which from the IPO proceeds, close to 150 crores is being invested in this new plant. This is an integrated manufacturing complex which will produce all the three product categories that we are in. Our power systems, our lithium batteries from the critical power domain, as well as all types of EV chargers. We are in midst of construction, and we hope to go live with production, or at least with trial production, in next calendar year, Q1. In terms of capacities, like I think the one comparison that I can draw, like today the three facilities which have come up, they have come up organically based on business needs at those periods of time. And while this capacity is a forward-thinking process of integrating all our products manufacturing into one, this is about an 18-acre complex in Hyderabad with almost 3 times the area than what we have in our current facilities.
Sorry, the new facility will be 3x the size of your current capacity combined?
The size in terms of the footprint, the area footprint.
No,
yes.
but in terms of manufacturing production?
In terms of manufacturing, there is the mother infrastructure is quite large, and as the market demands, in short period of time, we can build capacities to cater to market demand.
Okay. I just want to ask you something on the financials again. You've also seen negative cash flows in the past.
Yes.
As far as your working capital days are concerned, if that sort of extends beyond a point, that sort of has an impact on your cash flows as well. What is the current working capital days, if you can talk about that? And does the threat arise of negative cash flows going forward as well?
So you're right. Working capital management is important for us, and over the years we have worked very hard at working capital management. If you see at end of H1 FY24, our working capital is about a little bit south of 25% of our sales, and that's a significant improvement than what we have had in the past. Some of our businesses are high growth businesses which require a lot of investment in R&D product development. So to that extent, we will be in investment phase for the next couple of years. With respect to the negative cash flow that you're mentioning, particularly in FY21 and some part of FY22, there is an element of discontinued operation in our business, which is the reason for that negative cash flow.
Okay, a quick word then on promoter. Any intergroup promoter dealings, borrowings, guarantees that you could just elaborate for your potential shareholders? That's question number 1. 2, promoter shares, is it pledged? And 3, promoters will be paring their stake down in the offer for sale. What would the promoter stake come down from to, and why is it that the promoters are selling?
So the promoter and the promoter group stake is before IPO was about 92%, and after IPO it would be close to 70%.
Okay.
But the majority of the focus of this IPO and capital raise is the primary raise for growth of the company, with secondary being a much smaller portion. This is an important liquidity event, milestone liquidity event, and to meet any liquidity needs, personal liquidity needs, I would do the transaction at this time rather have an overhang in the future.
Promoter pledge?
Some of the shareholding, because of the working capital loan that we have, some of the shareholding is pledged to the bank. I don't...
Okay.
Yeah.
But with the money that you are raising now, will you look to bring down your promoter pledge?
Yes, that would be the objective.
That would be and one more question. Also, any intergroup promoter dealings?
No. So we are an independent company, board governed, independent board members, and all the related party transactions are looked at, approved by the board and the audit committee.
A quick supplementary question. HFCL, of course, the listed entity, also holds about 7.5% stake in the company. They're not the selling shareholders as far as the IPO is concerned. But what is the thinking on their side in about a year and a half, 2 years? Is there a plan to sort of reduce their holding also and unlock value for themselves as far as HFCL is concerned?
So I cannot comment on behalf of another company. They've held this equity for a really long time. And it depends upon their future outlook of how they treat this stake.
Okay. I quickly want to understand one point on your order book. At the end of the first half of FY24, your order book stood at about 737 crore rupees. What I want to understand is that what is the execution period as far as this order book in hand is concerned? And historically, what's the growth that you've been seeing year after year on your order book, and what carries on as far as the coming next 2 to 3 years are concerned?
So our order book at end of H1 is quite strong. And if you see the last 3 financial year data, the order book to revenue conversion cycle is reasonably strong. And because of the business of supplying products and some services attached with it. So whatever has been the trend is what we see to continue even in future. And based on the mix of EV charging and critical power business, the order book we think is going to take the path that we have seen in recent years and H1 FY24.
Okay, one clarification that I wanted as far as the critical power business is concerned, a lot of orders that you receive are through competitive bidding. Just want to understand the process. Is it the process which sort of says that if you have certain amount of financial strength, then you can bid for a particular size of order? If yes, then what is the range of orders that you are eligible to bid for as far as today's scenario is concerned? And how do you grow that? How do you go up that cohort in terms of larger size orders?
So every opportunity or tender does have eligibility clauses, but we have been in this business for almost 30 years. So at least I don't recall any significant business opportunity where we have not been able to participate because of eligibility conditions. Because in terms of deployment and experience and skill set and product certifications, we have that all because we have been in this business for 3 decades.
Okay.
Okay, Anand, thank you very much for so beautifully explaining your business and taking the time out and speaking to CNBC TV 18. Pleasure interacting with you.
Thank you once again for having me.
And wish you all the very best. Well, with that, it's a wrap of the show. Thank you very much for watching.